Welcome back to the channel and welcome back to the May mortgage interest rate update. This is something that we do every single month. We talk about the best mortgage rates in Canada, fixed, variable, and discounted rates. Make sure you stay till the very end to see those because the best rates in Canada are obviously at the very end of the video. But just like everything else in life, when you get the absolute lowest price, there are some catches and we're going to explain what all that means to you as well. The definitive guide on how to manage your credit: product, penalty, price, in that order. It's never been more important to get your mortgage right. All right, so welcome back. And obviously today we are going to discuss the discounted rates, the best rates in Canada, the best full featured rates. And this is something, like I said, that we do every single month, and this month is no different. This last month, April, saw interest rates go up a little bit, although not quite as much as they went up in March. We got a little bit of a reprieve from the rapidly escalating rates. Of course, we saw the variable rates go up as a result of the Bank of Canada's interest rate increases in April get translated through to normal interest rates. And that is affecting a lot of people as well. There are, of course, some people that should be looking at interest rates very closely right now. And that's not just people who are looking at new mortgages or who are looking at renewals, but people who already have existing mortgages and might be able to take advantage of some really strategic timing here. And that can be done in the form of a midterm renewal, a midterm early renewal, or a refinance. And we'll talk a little bit more about that. But before we get into it, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. We just crossed 25,000 subscribers, so stay tuned in order to find out what you need to do in order to win the $5,000 that we're going to give away. I'll give you a hint. It means you need to be subscribed. So if you haven't subscribed already, go ahead, click that subscribe button. It's free, it's easy, and it's definitely worth it. Okay, so let's get into it. And let's start first with those people who already have a mortgage. If you already have a mortgage, and let's say you're in the last 12 months of it and you're coming up for renewal, or let's say you've got an interest rate that's higher than 4% or is in that 3.5% range, but you're worried about interest rates going up considerably. So you're considering making an early move, either an early renewal or moving to an interest rate that is similar to what you have, but locking it in for the next 4 or 5 years. Well, now could very well be a good time to do that. I'm going to say that I don't have a crystal ball. I can't tell you what interest rates are going to do, but if you do believe that they're going to continue to go up, and let's say you're thinking that in a year or two, they might be at 5 or 6%, it might be a good time to, in the middle of your term, do a refinance or do a midterm renewal, or what we call a switch to a different lender, in order to lock in a low rate for the next 5 to 7 years. And if you're considering that, we can certainly help you do that at Mortgage 360. By the way, if you're shopping for a mortgage and let's say for whatever reason you aren't applying at Mortgage 360, but you want to have all the information that we can provide to our clients and that we do provide to our clients, we have put together a course called Secrets to Getting the Lowest Interest Rate. It goes through everything you need to negotiate with your bank, with the broker, and make sure that you don't step on any landmines or have any surprises in your mortgage that'll cost you $10,000, $15,000, $20,000 down the road. We've priced that course super low so that everybody can get at least some benefit out of it. And typically clients get 10 to 50 times their money back on the returns they get just by knowing what to say and how to say it and when to say it. So you can get that course by going to ratesecrets.ca. It's on sale for a limited time, and I highly encourage you to jump on that because it will give you the tools and the ammunition that you need in order to get the absolute best rate with the right mortgage for you. So that being said, let's get into the actual interest rates right now. We're going to start first and foremost with the full featured mortgages. These are the mortgages that have all the bells and whistles. They have all the features, the prepayment privileges that you would expect at the big banks, the service that you would expect at the big banks. And on the 5-year fixed mortgages, they have a significantly lower penalty if you find yourself in an interest rate differential situation. And they also have, on the variable rate mortgages, lower lock-in rates if you decide that you want to lock in down the road. So these are what we call our A+, better than the bank mortgages, and they start at 4.19%. This is for a 5-year fixed, full featured, and it is if you have mortgage insurance, so CMHC, Canada Guarantee, or Sagan Insurance, or you have greater than 35% down. These are the mortgages that represent the lowest risk for the lenders, therefore they are the lowest price. And subsequently, that is why you get the best deal. When you have between 20 and 35% down, those mortgages are higher risk because they have less of a down payment, which means more exposure for the bank. And subsequently, that also means that they are higher risk and they have a slightly higher price. Gone are the days where if you put down 20%, you get a better rate because 20% down is now the most risky mortgage for a lender, not a better mortgage. Now, moving on to the 20 to 35% down payment range, we are at 4.19 to 4.39. Again, remember, these are the full featured mortgages. These are the ones that if you want to move midterm, let's say interest rates go down in a year, and you want to move midterm to a better lender with a better rate or a different lender with a different rate, Well, you can do that because you're going to have low penalties and the ability to move, as well as all those abilities to make your prepayments. By the way, I'm going to link up right here. We did a video on the best banks and lenders to get a mortgage at recently, and you can check that one out to see where the absolute best mortgages in Canada are. Now, moving on to variable rates, these have gone up slightly to about 2.3%. This is reflecting the 0.5% interest rate increase that the Bank of Canada had around the beginning of April. And you can see that these variable rates are going up. Now, notice that they're still about 2% lower than a fixed rate mortgage. So in order to decide between a variable and a fixed nowadays, what you have to do is you have to consider, do I want to pay the premium for a fixed rate mortgage? Then you have to calculate what that premium is. So you calculate the payments on a variable and then the payments are on a fixed. You'll see about what the difference is in the payments. And then you for yourself have to decide if you want to pay that extra money for that 5 years of security. And most people right now in our business anyways are still opting for a variable rate mortgage because what they're understanding is that if there's a 2% difference between the interest rates, then you have basically 8 interest rate increases or the equivalent of 2% in interest rate increases where you are saving money. And then you're going to need about the equivalent of another 2% in increases after that to cancel out all the time that you've been saving money. So it takes about a 4% interest rate increase before you're going to be worse off. Most people don't think that's in the cards. Some of you do. You can leave what you think in the description below because I know you're going to do it anyways, regardless of what you think. And I'm totally cool with that because this is an open space for people to come and talk about mortgages and real estate. So fill your boots. Now, moving on to the 20 to 35% down payment range. If you're getting towards that 35% down payment, you're going to find yourself paying about the same as for an insured mortgage at 2.3%. And if you're putting that 20% down, again, that's the most risky mortgage for the lenders. You're going to basically be in that 2.65% range. Now, moving on to the discount mortgages, we're going to start with a 5-year discounted fixed rate. And I'm going to preface this whole thing. The whole disclaimer is, like everything else in life, you get what you pay for. So in other words, if you're getting a discount mortgage, if the price seems too good to be true, well, it probably is. So guess what? This mortgage, and all the ones that follow have certain things that have either been stripped out of the mortgage in the way of features, or they have things like bona fide sale clauses, which basically means that you can't switch to a different lender and you can't refinance unless you're refinancing with the existing lender that you're at. I'll talk about in a second why that's a problem on a variable rate mortgage. But basically, they take things out of the mortgage to ensure the profitability of the mortgage, which is why they can give you a lower rate. So you need to understand what those things are. That's what we talk about in Secrets to Getting the Lowest Interest Rate course. And that's what we talk about specifically with our clients when they come to Mortgage 360 to get a mortgage. So a 5-year discounted rate priced about 3.99% right now, which is about 0.2% lower than the full featured rate, which is a cup of coffee per week per person on the mortgage. If it's a small mortgage, it's a Tim Hortons. If it's a big mortgage, it's a Starbucks, or it's your favorite beer or your bottle of wine per week. You have to decide for yourself whether saving that cup of coffee a week or that bottle of wine a week is worth it to you in order to get the lower interest rate. Don't let your ego get in the way on this. When you go to the water cooler and somebody else says, well, I got 3.79, and you go, well, I got 3.99, when you could have taken 4.19, because at the end of the day here, the people with the best features on their mortgages are the people who are going to win in the long run because they're going to have the ability to switch to different lenders for lower interest rates. They're going to have a lot more flexibility, and that means a lot, especially when it comes time to renew your mortgage or to switch to a different lender. Now, on the 5-year discounted rate, between 20 and 35% down payment, you're looking at between 3.99 and 4.19. On the variable rate, you're looking at about 2.05 on an insured mortgage or greater than 35% down. Now, I mentioned why discount mortgage rates, especially with bona fide sale clauses or no switch to a different lender clauses, as we like to call them, are so problematic. And that is because in the event that you decide that you want to lock in your mortgage, at that point in time, you can't switch to a different lender. Therefore, you have zero leverage. You can't say, well, I got offered such and such over here, because it doesn't matter because you can't switch to a different lender. So you lose your flexibility, you lose your ability to go elsewhere, and therefore you are pretty much at the mercy of the lender that you chose when you get a discounted rate. And they can pretty much tell you that you have to pay whatever rate they say if you decide you want to lock in or continue with your variable. So if you're a variable rate borrower, you know you're going to do it for the next 5 years. That's totally fine unless discounts get bigger, and then you're going to lose out on that. But for most people, it's worth paying the little bit extra on a variable to make sure that you have the option to leave in the event that you decide to lock in, so you can go and negotiate a better deal with somebody else. So that's your hot tip of the day. Now, On the 5-year discounted variable rates between 20 and 35% down payment, you're looking at 2.05 to 2.6%. Again, the 2.6% being at that 20% down payment range, and the 2.05 being as you get closer to 35% down payment. Now, there is one other mortgage that we've been talking about quite a bit. It is a 3-year variable. The only reason why we were talking about this is because it is a really good rate and a really good discount. It doesn't give you as much of a time horizon as a 5-year mortgage would, but this 3-year rate is adjustable, which we prefer over variable rates, because variable rates, your payments don't change, but the amount of money going to principal does, which can cause you to have payment shock when the mortgage comes up for renewal. I'll have a video on that in the coming days, but this 3-year mortgage is a full feature. You can switch to a different lender at any time, and you can get it at 2.05% right now, which is a really great deal for a full featured mortgage. Now, like I said, in the next couple of days, we are also going to have a video on variable rate mortgages and what you need to watch out for if you have one. And I'm talking variable here, not adjustable. So if you have the type of mortgage where your payment doesn't change when interest rates are changing, I'm going to have a really important video for you to watch on that. And we're also going to have a video on the Vancouver and the Calgary real estate market. So stay tuned for that. And if you found this video useful, do me that favor, hit that subscribe button, hit that notification bell. Please hit that like button so more people like you can see this video. Don't forget to watch for more details on how to win that $5,000, and we'll see you on the very next one. Cheers.